there's a way to monetize from risk, but then it takes a very prudent, a very astute risk and financial control manager sitting and saying, how can we make this work for us? Yes, there's a way. The cost for GRC, or governance risk compliance, has now ballooned to almost $75 billion, just Asia Pacific, and not including Japan. GRC, governance risk compliance, has no tangible ROI behind it. So when a bank spends $100, the first question is, what is my tangible or immediate or softer ROI? GRC doesn't have that. So when this balloons to 70, 80, 100 billion, banks are saying, can we do the bare minimum? So I don't think the institutions went and said, let's cut costs. They can't. Regulators mandate it, governors mandate it, compliance mandates it, security and risk mandates it. So they have to spend KYC, anti-money laundering, governance. But they're saying, look, can we do the bare minimums? And that, you're right. I mean, in 2015, they're saying, what is the minimum lowest denominator? Can we just spend that, take the box, and get it done with? Right now, we are advocating something dramatically different. We are saying, do what is necessary, but use that same compliance spend as an enabler. Let me give you an example. You have to be extremely strict with regards to PCI DSS, Payment Card Industry Data Security Standard. Everybody cried foul. Come on, that's a lot of money being spent. There is no tangible ROI, just a regulator, and this is becoming ridiculous. We said, if you have to do it, and if rape was inevitable, which it was, we're saying, why not turn it around to your advantage? They're using the same set of compliance rules to cause customer delight. They're using that as a marketing campaign. They're going to people and saying, we are now the most secure bank in Singapore. We are now the best run bank in Thailand. And people are saying, that's not bad. So they've taken the same compliance spend. They have to spend. They can try and do minimum. They can go the whole 9 yards. But now they're spinning around into a more profit center rather than just pure spend. Every institution, retail, corporate, or financial services players have what they call a compliance framework. A fairly robust, a fairly enterprise-wide compliance framework. What that means for retail, for example, if you have any dealings with an American or an American company, you have to be compliant to FATCA. Every single institution in the world which is registered at a bank has to report into Bank of International Settlements with Basel III. If you look at the nuances of Basel III Accord or Basel II Accord, there's lots and lots of fragmentation around market and capital risk, technology and operations risk, capital adequacy and other provisioning risk. So we are saying, if this is again inevitable, why don't you start looking at leveraging? So these compliance centers, instead of becoming cost center, like the early days of IT being a cost, compliance is now driving change. Guys, we have to aggregate and supply all of this data to the regulator. Can we use this set of data for something else? Raising capital, for example, doing capital adequacy adjustments in the framework. So they've found a little imaginative, creative way of using the same spend but trying to profit from it. If I am an extremely well-balanced bank, I have the bragging rights to call myself the strongest bank in the world. Who would have thought of that pitch earlier? Now they can. So that's the way they're making profit out of it. Can financial institutions monetize risk? The answer is yes. There are examples of institutions that have done it. There are examples of institutions that are still limping. A governance, risk, and compliance framework, this whole framework that every institution has to do, or a checklist if you call it that, is nothing but a day-to-day monitoring and reporting of facts. That's what a framework is. That's what risk is. Constantly monitoring the threats. It could be internal threats. It could be external threats. Now, external threats are phishing, attacks, hacks. Internal threats are identity, access management controls that you put in place. Internal threats are also capital and a stringent look on capital. Non-performing loans are internal threats. If that goes out of hand, we have the fiasco of 2008. Institutions after 2008 have started understanding this is necessary, this is mandatory, and they're taking out components to monetize it. If I'm extremely good in looking at managing my non-performing loans, I have narrowed it down to an art. Now I can go to market with a bit more audacious loans book because I know what the threats are. I've got a historic accord of what to watch out for. So my loan book is cleaner, my loans are more secure, and my NPLs go down. Tick. We made profit out of a data set. If I'm able to manipulate my capital adequacy and balance my books more accurately at the end of the day, and I know my exposure not only to corporate, to retail, but the whole financial instruments, I can make more profit. I can do interbank borrowing or lending. Tick, I make profit from it. So there are various institutions that have, I think, almost succumbed to the pressure that we have to spend. And there are institutions that are almost getting the knack of spending and ultimately making profit from it. So yes, there is a way to monetize from risk, but then it takes a very prudent, a very astute risk and financial control manager sitting and saying, how can we make this work for us? Yes, there is a way.